Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's June 27th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. Man, it's so crazy right now. I was watching the World Cup game a few days ago. Portugal played against Iran, which ended up in a 1-1 tie. Portugal was winning 1-0. It was late in the game, about 20 minutes left. And that's when Ronaldo got called for a penalty for knocking someone down. And they went to the video replay, just like they do in the NFL, right? These video replays to see everything that happened during the foul. Ronaldo clearly elbowed the defender in the face while trying to go by him. And it wasn't violent, it might have been a little bit on purpose. It wasn't, it didn't hurt the guy or anything, but it was clearly an elbow to the face, which the rule states is supposed to result in automatic red card. Now, for non-soccer fans, hopefully basketball fans, it's like a flagrant 2 in basketball, where the player gets kicked out of the game immediately. But with a red card, it also means a player will get suspended for at least 1 game, maybe more, depending on how serious the penalty is, which is a huge deal in the World Cup, right? It happens every 4 years. I went to Brazil last year. I was thinking about going to Russia. I didn't go this year. Too busy with the business. But it's such a big deal because you're going to elimination rounds now, which means if you lose, you're done. That's it. You got to wait a long time to get back here. After looking at the video, there's a reason why I'm telling you the story. The ref gave Ronaldo a yellow card, which is like a slap on the hand, basically wanted that, hey, you know what? You better not do anything stupid for the rest of the game, or you're going to get a red card, you're going to get suspended, blah, blah, blah. So I'm watching this live, and the announcers, again, when the refs basically, on the hood looking at the replay, the announcers are seeing the replay for themselves, and they're agreeing like Ronaldo should get suspended. It's clear elbow to the face. There's going to be terrible news for Portugal. They better prepare because if it's a red card, you have to leave the game right then and there. And you play a man down for the rest of the game, which is dangerous, right? So I'm laughing at the announcers because there is zero chance that they're going to throw out Ronaldo and throw him out of the game suspended. Zero chance. Zero. I'm not sure if you watch soccer or know who Ronaldo is. He's basically more important than the Pope to most of the world. And I'm not even joking here. And picture Michael Jordan, who is a popular figure to hundreds of millions of people. Ronaldo is worshipped by billions. Since soccer is an international sport. He's the greatest player in the world right now, arguably one of the greatest to ever play the game. Don't go crazy and email me. But yeah, there is some fact to that if you look at the history of what he's done. And funny thing is, Ronaldo is going to be the first person to tell you how great he is, how good looking he is, because he's the most arrogant person in sports, which I love. I love to see from athletes. Yeah, that confidence. I'm the greatest. I don't care if you like me. If you hate me, I'm going to prove you wrong. That's how he is. So he's a very popular figure. People either love him or hate him, so they watch him even more. And when it comes to America, where soccer is not all that popular, if the ref threw Ronaldo out of the game, who's leading this year's World Cup in goals, right? Already doing great. Suspend him for next game is a strong possibility that most Americans, I would say even up to 60%, might stop tuning in. Because outside of Messi, who plays for Argentina, superstar, not advanced to elimination round, and Neymar, who plays for Brazil, those are the popular players. I mean, Ronaldo isn't the only person that they know. Right? There's like 2 or 3 of them, again, for non-soccer people who are watching the World Cup. In other words, it was a 0 chance Ronaldo was going to get kicked out of the game, especially given that FIFA is the most corrupt sports organization in the world, right? They don't want to lose ratings. These guys are supposed to get paid a certain amount of money, and they have mansions in like every country. Yes, the bribes that go on to get the World Cup. I mean, Qatar was great, right? You're going to have basically the World Cup of Qatar where it's like 125 degrees, which is insane. So, some money was actually, it's proven, has been set out there that, a lot of money's been passed hands to get that deal done. But I like the World Cup. Hey, where else can you see a grown man who are incredible athletes. They're strong, they're smart, they're fast, they're coordinated, and they get brushed by another player on the shoulder and fall down like they just got shot in the face. And they start rolling on the ground for like 5 minutes because their team's leading and they want to kill the clock. And then they go back to the video replay. Keep in mind, there's billions of people watching. And you see that the guy just got tapped on the shoulder and he's holding his face and checking to see if he's bleeding and go. I mean, you think that would change, right? I mean, for example, when you're looking at hockey, you don't really see these people throwing themselves on a flag. I mean, you might see them exaggerate when they get tripped to try to get a call. But when these guys are laying on the ice for longer than 20 seconds, there's blood all over the ice. It's everywhere. They're not faking it. In football, if you get hurt, you come off the field. Why not have the same in soccer? If the play is down for more than 2 minutes, they got to leave the field for 10 minutes. Throw a sub in there. They can't come back in for a while. It's the only thing I don't like about soccer. Yeah, it's a little bit of a soccer rant. I do like it. Again, I've been to the World Cup, and Brazil's fantastic, unbelievable. And it's going on right now. It happens every 4 years. And I know throwing yourself on the ground and pretending, it's the culture. It's never going to change. But you would think you're on the biggest stage in the world, billions of people watching. And is that the image you want people to have of you? And getting tapped on the wrist, going for the ball, and you scream in pain like your wrist just got sawed off, only to get up, a minute later and then run full speed and score a goal. Oh, I'm cool. Everything's fine. Yeah, high five. And you run full speed around the crowd, around the field. Hey, this is awesome. Anyway, I'm enjoying the World Cup. So, like, England is my sleeper, although they're not much of a sleeper anymore. You do look great. And Spain is probably going to win it. Not really playing up to their potential right now, but I mean, it's still the best team on paper. Should crush Russia. And they look good. Defensively, they don't look too good, but still, I think Spain is definitely in the lead. Germany's made the elimination round. It's going to be very exciting. But Spain is still my top pick to win. And oh, yeah, the reason why you're tuning into this podcast, the stock market. Just watching the market come down. I mean, the last time I did this podcast a week ago, I think the market has declined. I think it was 3 days into that podcast and another 5. So it was 8 straight days. And it went up, maybe a couple more down days, but it's declining. I'm getting lots of emails. You're worried, trade fears, what's going on? So, of course, I'm going to address this. Because some believe, well, maybe these trade wars are for real. I'm not going to go back into that. Others believe it's tensions in the oil markets. This is before OPEC agreed to a small and expected raise in output, which is no surprise. Listen to this podcast. Right? The last time they really messed around with quotas and said, okay, we're going to increase the supply to unlimited and go crazy was 2014, and they lost over $1 trillion with the oil collapse from over 100 to, what was it, $20 a barrel? I think they learned since then. They don't want to crash the markets here. And what do you see, right? When the markets go up and down, you're watching TV, reading blogs, you're looking at different sites. And these sites and the media, they always have to give you an excuse, right? They're not allowed to say, the markets are down simply from profit taking or funds are rebalancing out of technology and maybe going into oil or financials. And it's funny because they have different headlines. And I love when the market's like flat and it's getting 5 minutes to the close. And if it goes up like 30 points, the headline's like stocks move higher because, and if it goes down like 20 points, it's like stocks went down because, just because it's like, basically the difference is a few points in the Dow. Again, I'm using the Dow. It's not the best measure of the market. The S&P 500 is, but it's just funny how they have the different, like there has to be an excuse. But right now in the marketplace, right now, I like what I'm seeing. And think about it. How often over the past, say, 5 years, have we seen a gradual move lower in the stock market or a healthy pullback after years of a significant run-up? Right? We're used to 500-point one-day pullbacks in a Dow, S&P falling 2% in a day. I mean, the trade fears, potential new elections in Italy that could, crush the euro, the 10-year yield, right? I mean, holy cow. Let's go back to the story. It's going to push through 3%. Buy a cave. lock yourself in a room. It's just crazy. We hit 3.1, 3.2, came back down. Everybody's still alive. Everything's fine. But still, those are significant news stories. It pushed the markets down a lot in a short period. This pullback's a little different. And look, I own stocks personally that are pulling back just like yours in this market. But the way I look at it, as long as my thesis is still intact on these names, I'm being smart. I'm holding them. I'm going to add a little bit to these positions to improve my cost basis. And I know this may sound crazy. You're adding to positions on a pullback, right? Because when the market falls, what happens? You see all these stories come out and panic. And the first reaction is, hey, you know what? Let me follow the crowd and sell everything. Especially if this continues, right? Because it's been going on. You're seeing weakness in the markets. Markets are now down for the year. Some sectors are off 20% from their high. So they're going to say financials are in crash or, correction territory is a 10% pullback from the highs, 20% pullback, which you're seeing in several sectors. It's a crash. And you're going to see these crazy headlines. And your immediate reaction is, let me get out of the market. This could be it. This could be the 60% pullback everybody was talking about in 2010, 11, 12, 13, 14, 15, 16, 17. It could start now. But guys, don't panic. It's a healthy pullback. Like I said, it may continue. But when we look at the underlying fundamentals, economic conditions are still very strong. Looking on the housing front, manufacturing, jobs. You look at GDP, expected to surge 4% this quarter. Who had 4% 9 months ago? 4%. Earnings and sales still expected to grow well into the double digits over the next few quarters. Stocks, not all that expensive. 17 times forward earnings. Given the massive growth we're seeing, some people would argue, I'm just telling you the facts. We usually trade around a 15.5 PE, but earnings are used to growing at 8%. We're growing more than double that, and we're just trading at 17 times forward earnings. They're not super expensive. They're not cheap, but they're not super expensive. We're not looking at 40 times like, before the NASDAQ crashed or anything. Now, what does this all mean? Start making a list of names that you want to buy if the market pulls back further. Intel is down after 2 downgrades. The CEO was let go. Personal reasons. Had an affair. You're hearing inside. There was one downgrade suggested that they were just looking to get rid of him. It was much more than that. For Nomura, which is a downgrade, which is interesting. But they've raised guidance for next quarter to mask the CEO news. And that guidance include record earnings, record sales. Plus, the stock is super cheap here. Hey, that's a buying opportunity. Look at other large cap names. Look at the financial sector I've been talking about for the past 2 weeks. Dirt cheap, about to announce huge buyback plans and raise their dividends following the stress test results, which everybody passed as expected. But try not to panic when the market is going down. If you look at the greatest investors, they love to see market pullbacks. Why? Because they can buy more of their favorite names at cheaper prices. So the rest of the world is panicking because they're watching news highlighting how higher interest rates, trade wars, debt concerns, and keep pushing stocks lower and lower and lower. Just be smart. Make a list of those stocks you want to buy in a further pullback, which is a strategy we used on almost every pullback we've seen over the past 24 to 36 months. If you listen to this podcast, and you know what? You should have made a lot of money by doing that. That's how I'm playing the market. Again, don't get crazy. Don't get panicky. Be smart. And while everyone else is selling or looking to get out of the markets and reading these crazy headlines, again, the fundamentals are strong. The economy is still strong. Good footing. Use the opportunity to add some of your favorite positions and actually buy into some new ones. Now, I have a great interview today. Actually, a first-time guest. Has been analyzing the markets for over 20 years. Her name is Lenore Hawkins, who is a chief macro strategist at Tematica Research. We've seen all over the media, especially on Fox Business. Works at the largest financial institutions, including JP Morgan and Accenture. And today she's going to break down some of the biggest risks we're hearing and seeing today in the market. This includes rising interest rates, the trade wars, earnings, which we're going to see slower growth year over year starting in 2019. Sounds like a long time away. It really isn't. It really isn't. Okay? A few quarters away. There's going to be a really awesome interview with Lenore. We'll also share her favorite trend where investors still have plenty of opportunities to cash in on. And later on in my educational segment, I'm going to break down a multi-billion-dollar sector that our government created last month out of thin air by making this simple rule change. The trend you need to get familiar with because there is enormous upside potential for several companies within this sector. It's being addressed a little bit in the media. Unfortunately, there's also several companies that this rule change is going to hurt. And I've seen analysts in the media talk about these companies, make me worried, which these are not the names that are going to benefit from this. Again, it's a big trend. You're going to know exactly what to talk about when I mention it. But I want to tell you exactly, break it down, get the record straight of who the winners and who the losers are going to be and how to make money on this landmark decision. Before I break down this incredible new sector, let's get to my interview with macro expert Lenore Hawkins. Lenore Hawkins, thanks so much for joining us on Wall Street Unplugged.
Thanks for having me.
Well, so first-time guest, I want everyone to be familiar with you because you're the chief macro officer at Tematica Research. And I know what macro means, you know what macro means, but could you tell my listeners exactly what you do? Because macro can entail hundreds of things, right? From analyzing the global economy, researching something specific within the economy like housing, or even analyze a specific trend like maybe AI or cloud.
Very true. Yes. Well, for me, the macro focus is looking at the big picture of what's happening in the global economy and then down as well per country to get an idea of the big trends that are affecting us. For example, big macro trends that you can look at are things like an aging demographic, right? As we've got the baby boomers all over the world, either in or heading into retirement, how is that going to affect the global economy? Macro also involves things like looking at what's going on with monetary policy all over the world, right? So you probably hear in the headlines people talking about quantitative easing and now quantitative tapering. And that's basically the Fed putting kind of more money out there in the world by pushing down in the interest rates. And when interest rates are lower, it's easier to borrow money because it costs you less. And that's going to have an impact on the economy. So macro is looking at those big picture things and figuring out, okay, how are these big picture things going to affect the economy? And then even more importantly, what is that going to do to the investable world?
Yeah, and thanks for explaining that too. I mean, we call it like top down as an analyst too, because you look at the macro picture, then maybe the sector and determine what stocks in that sector, if you like banking or whatever. If interest rates going higher, you could say, okay, that's good for banks with net interest margins. Okay, JP Morgan's the best bank or filtering out. But
exactly.
Thank you so much for explaining that because you've been doing this a long time. I don't want to say how many years, right? Because I've been doing this for over 20 years and people say, wow, are you old? And then, but I'm saying as a compliment to get, because you've been doing this for over 2 decades and you have a lot of experience. I know you worked at Street and other places. I want to ask you about current events right now and stay in the macro level where you're seeing tariffs right now in the news, and they've been in the news for a while, right? So now you've seen the market come down. I'm not too sure if it's from tariffs or if we're just seeing your gradual pullback after going up so much, which is, pretty much, little by little. It's nothing crazy. But what are your thoughts? Well, and you never want to get political here, right? And I try not to be political as well. Right. Just get to the facts. But we're placing tariffs on imports from China and Europe, 2 places that have incredible surpluses, and many consider unfair trade agreements with us. I've argued that this isn't really going to be that much of a story later on because, one, if you look at China and Europe, they kind of, the trade policies are unfair, and I think they need to be fair, right, if you really look at the facts. And 2, they have a lot to lose where you're seeing, a potential recession in these economies if we actually have trade wars and this goes on for a few months. You're actually seeing that in those markets right now, which are declining more than ours. I want to get your view. Am I crazy because you're the professional, or, is it a big deal or is it not a big deal?
Well, I think what we're seeing right now is the market asking exactly that question. Is it a big deal or isn't it a big deal? And like you said, you never really want to get political with this. Now, putting aside just even on a personal basis, when you're looking at the markets, you have to leave your policies, your personal preferences at the door, because it'll color your analysis of it, right? It can't be that, I like this guy and his stuff's good, or I don't like him and it's bad. But what we got to do is just look at the plain facts. And like you said, we have problems with trade. The challenge here with what's going on is we're going around the normal process that we, the United States, created to address these issues. We created the World Trade Organization along with a couple other countries, but we really were the ones driving it. And the World Trade Organization has historically been a fairly effective way for the United States to address these problems when we see something that we don't like, where we think somebody's kind of cheating us. And right now, we're very much going about that kind of backdoor, and we are in effect now, unfortunately, we're violating the very laws, the international laws under the World Trade Organization that we helped create, because those rules say, if you got a problem, you got to come to the WTO and deal with it there. We're not doing that. And we're saying, all right, we're going to launch these tariffs. So we're judge and jury, and we are going to launch these tariffs. And the big problem here is it seems every day it's getting a little bit more heated, and there's a lot of kind of generic threats being tossed out by everyone, not a whole lot of specifics behind it. And that instability alone, forget if anything even really comes of it. Forget if we just have all this yelling back and forth and nothing really comes of it. That in itself is going to slow down the global economy, because all rational, reasonable, responsible business owners are going to go, uh-oh, I don't, things are changing. This is nerve-wracking, right? Because we really like is predictability. And right now, the level of predictability keeps going down. So people are getting nervous. And we've already got in Europe, well, yeah, the trade hasn't been so great. You've already got Europe very nervous about what's going on with the current administration. Because I'll give you an example. In Italy, you had a bunch of companies that were starting to work with the Middle East, providing them with materials. They were doing nothing wrong, right? Because everything with Iran was following the rules under the agreement that Obama put together, and how these companies were building up to help supply Iran now that the sanctions had been lifted. Well, the United States single-handedly changed all that, and now suddenly these are companies that were going to be working with Iran. They're having to fire employees. They're having to, they've wasted all this money on expanding their productive capacity. And that's happening in a country that was already struggling. So you have it in France as well. So you have these companies that were saying, well, wait a minute, we didn't do anything wrong. We were following the rules. We were doing what we were told we could do. And things just got flipped upside down. And so we've already seen where companies have gotten really hurt, trusting that the United States was going to do what it said it was going to do. Now we're telling the world that we may just change our minds without a whole lot of notice. That in itself, even if we don't do anything more, that in itself is making people a little bit nervous, and that is causing less investment. And that's one of the big things that's serving as a headwind to Europe. And that on top of a rising dollar, because people are getting very nervous and they're moving towards, what's the one thing we can count on? All that serving as headwinds.
Now, that definitely makes sense. When you're looking at this and you're seeing the noise, right? Where you're seeing, it creates uncertainty. Is this more about saving face? Because if we actually came out, which we did come out, and say that trade is unfair, we're going to raise tariffs on you. And if China and the EU said, okay, we'll make it fair. I mean, it's really that would never happen, right? It's really coming to a position of weakness. Is this the EU in a lot of the headlines, and you're seeing whether it's Harley Davidson or, autos with EU, and China, of course, where it's going back and forth? China's response, the EU response, is this more just to save face in the general public? Where do you think, like, behind the scenes, these guys are really talking to see what they could possibly do? Because I see it that way, where obviously China and the EU aren't going to say, okay, the U.S., whatever you guys want, this is perfect. I see them putting up a fight, but behind the scenes, it seems like this almost has to get done. I mean, you're seeing the effects where maybe our economy is falling or our stock market is falling because of this, but we see that their markets are falling much more. So you would think that something has to get done, right? Right? Is that what you would predict, or do you really think that we could see this go on for months and months, which would definitely impact the global markets?
Well, the people making these decisions are politicians. And the way they get elected is by getting people to think they're fighting the good fight for them. And right now, you have most of the economies, the developed economies in the world, very nervous. And you have this rise of nationalism. And when you see that, it becomes we're the good guys and those guys are the bad guys. So, and the US has done a very, we're really definitely doing that, where we're the good guys and those guys are the bad guys, and trade is bad. We're getting screwed. Now, Europe is doing the same thing. Italy is in the same position. France is in the same position, where they're saying we don't really like what the US is doing. So it's all about your perspective, right? Because they kind of have a similar perspective where they think the US is being unfair. So if you're a politician, forget the long-term results, because all these trade wars, like this stuff, it takes a bit for it to pan out. So it's not like you immediately get a report card on, yeah, that was a good decision, that was a bad decision. The problem is we have the United States saying, you guys are screwing us over and we are going to make your products way more expensive. That immediately can cause harm to European companies, because it's either more expensive for them to sell to the U.S., or it's more expensive for them with steel, right? To importing steel is more expensive coming into the U.S., so they're less competitive. Their people who are going to be voting for these politicians, they immediately see, well, wait a minute, that just hurt me. It's harder for me to sell things, and it's how do you get them to vote for you if you don't say, no, US, we're going to do it right back to you? Because it's not about, you're right, the realities, but the realities of global trade are something very few people actually understand, because it is way too big picture, way too complicated. Throw in the impact of exchange rates on all of it, and people really just don't understand. What they do understand is yelling and screaming on Twitter.
Yeah, no, and you hear the yelling and screaming all the time. And it is difficult to understand, right? Because you brought up a good point when I asked you the question, right? You said you don't know, the market's trying to figure it out. I think that's a good analogy. I mean, not an analogy, but a good response to this, because it seems like we're trying to figure it out.
Yeah, the market, none of this is straightforward. And there are so many factors involved in it that we don't really know what's going to happen. And we also don't really know how this administration is going to move forward, because this is a very different game than we've ever really seen with a presidency. So trying to figure out, like, is this out of his playbook, from his book? what exactly is he doing? And that in itself is enough to make everybody go, okay, I'm just going to stop right here and wait to see how this pans out. And that alone slows things down, right? And then that can kind of become a spiraling downhill, because business likes predictability. It likes to have a high degree of confidence as what is the playing field going to look like 6 months from now, a year from now. And no one really knows too how to respond to these things, right? Because the other countries, like, wait a minute, we have not seen a guy like this. Now, love him or hate him, we've never dealt with something like this, and they're not really sure how to react, right? Because if they knew, you've got kind of a game theory playing out here. If other countries knew, all right, well, if we come back really strong and then kind of cave, it'll work out. Well, they can't, they don't know. They don't really know his game. So it's difficult for them to even play this out as well. And all of that, again, ends up with everything slowing down.
Now, you bring up a point where predictability, right? And I want to change to interest rates, because we're seeing, the Fed made it clear they're going to continue to look to gradually raise short-term rates. Rates have moved considerably higher since mid-2016, actually double when you're looking at the 10-year yield.
Yeah.
How much of a concern is rising interest rates? Because I know you're right about that when we talk about the debt levels, but also when we look at risks, like the biggest risk comes from things we can't see. And the whole entire world knows that the Fed's going to continue to gradually raise interest rates while looking at the data. But at what level does it become something that we really need to worry about? I mean, what rate do we need to see? I know we don't want to go too high, because we're actually, a nation filled with debt, especially not only on the government level, but consumer level.
Yeah, I think the big thing there's two aspects to this rising rate environment that are concerning. One of them, like you said, is just the level of debt. Just in the United States alone, we have an absolute record level of debt when you look across the federal, state, local, and household debt levels. We've never seen anything like that. What's really concerning is just how much households are already stressed when it comes to the percentage of their disposable income that's going to pay off existing debt levels. So as interest rates go up, as their credit card rates get more expensive, as any kind of short-term rates like auto loans, student loans, right, as these get more expensive with rising rates, they have less and less of their disposable income left to spend. The other aspect that's very concerning with this is in a rising rate environment, on top of the US economy, while not great, still better than what we're seeing in a lot of other places in the world, the rising rate, better economy means that the dollar is becoming more and more attractive. As the dollar becomes more and more attractive, that's very painful for the rest of the world because you've got a lot of dollar denominated debt out there, tons of it out there. And that debt, as the dollar gets stronger, that debt becomes more expensive. And that means that more money is going for countries outside of the world, outside of the United States. More of their money has to go to servicing that debt. And that means they can't buy other stuff, right? They can't buy things from us. And where we can kind of get into a spiral, whenever we see the dollar rising significantly, you start to see a lot of weakness in emerging markets. And we've actually been seeing that this year in their stock markets.
No, and that is a great point. I mean, it's not just tariffs that, and negotiations that are really, again, we had the EU and China with big surpluses. They have a lot more to lose. But now with rising interest rate environment, it's, you got everything, just huge headwinds coming at them at the same time. And when we look at the U.S. economy, though, right, so we're raising rates because the Fed sees that the economy is on good footing. Now, when we look at a GDP number, everybody thought this number was crazy not long ago, but we're going to see probably 4% in Q2. Mm-hmm. What should individual investors know about this number? Is it sustainable? I know GDP gets revised 3 times, and this number could be 2.5%, right, in a couple months, right? So, and right. No one's going to really talk about it. But with projected 4%, which was a crazy number when I know the current administration mentioned it earlier, or maybe not early, maybe about 6 months ago, 9 months ago. But could this be sustained, or is this just a one-time thing? Is this like, because what worries me is maybe people look at this number and say, oh, wow, the economy is absolutely perfect. And, they're not really looking at earnings, which year over year are growth's going to slow considerably year over year, which you wrote about on your website. And, and the Fed's still in hawkish mode, right? Looking to raise interest rates here. Talk a little bit about that, because I don't know if this 4% number we could really rely on.
Yeah, and a good bit of this, like you said, that number is driven in a decent part by one-off events, the tax cut, right? That tax cut and the repatriation, those were one-off events, meaning that the difference between one quarter and the next, that big difference as far as your tax rate, happens once. Going forward, right, the tax rate doesn't get cut again. So you've got that one-time break that's going to make things jump up. And we didn't really see that much in the first quarter. We're seeing the impact of those tax cuts are really hitting more in the second quarter. But like you said, the expectations for corporate earnings are that they're going to keep slowing down more and more and more. And we're actually seeing things that are more like long-term picture as far as the spending on durable goods are slowing. We're seeing indications that these things that are more long-term out there and not sentiment-based, but actual activity expectations around orders for those big picture items that you expect people to buy when they think things are going to be good in the long run, those are starting to definitely slow. And when you see corporate investment in those big picture items, when that's not going so great, but then how can it be that great when you look at the level of debt on corporate balance sheets at a record high? That makes it a little bit tougher. Putting that all together, I'm not seeing a whole lot of reasons for really strong growth going forward, because if you think about it, the growth of an economy is a really simple thing. It's just 2 factors: the growth of the labor force and growth in productivity. Well, we all know the labor force is not growing very fast. Right, you've got this aging population, so that's one thing. You've got a more and more big bulk of the population is either in or moving into retirement. You have a smaller generation behind it, the X generation. Now, that generation is actually struggling as well as far as putting in a lot of labor hours, because their parents are retiring and struggling because they don't maybe have as much savings as they need. So the generation behind them is finding it a little bit tougher to get all the hours in that they need at work, because they're having to help their parents. So they're having a tougher time putting in those hours at work. and they're actually not able to spend as much as they like because they're having to help mom and dad because mom and dad didn't quite save as much as they probably should have. And they also got hurt during the big financial crisis. And then after the financial crisis, they were really hurt where these suppressed interest rates, so they couldn't rebuild their portfolio that well. So we have a baby boom population that does not have nearly enough money to help them in retirement. So the generations behind them are having to help support them, which means that they're not able to buy that much stuff. So there we got problems with the labor pool. As for productivity, well, we haven't really been investing a whole lot in our productive capacity. What we've been seeing is things like share buybacks. We've been seeing dividend payments, right? Corporations haven't been putting a ton into improving their productivity. Part of what we're seeing is because they're not so confident about the future of the economy. But part of it too is it's more and more challenging to get those productive improvements the more advanced an economy becomes. China was able to have incredible productivity because it moved from a rural, relatively agrarian population with very, very low skilled people. You take them from agrarian working on the farm into a factory, going from a factory into high skilled jobs, massive improvements in productivity. The US, it's already a fairly high skilled economy. So getting those extra moves up is a little bit more challenging.
You sound like that you're more leaning towards bearish. I mean, I sound like a bullish because I've read your stuff and I know where you're coming from. So I'm kind of playing devil's advocate this way.
Yeah, cool. Go ahead.
Yeah, debate, which is cool. But you sound like you're worried when it comes to debt levels, where it comes to slower growth. I mean, how much impact if say individual investors, like how concerned should they be? Should they be looking at, well, right now, if you look at earnings, they're still they're not expensive. If the earnings that we reported right now, we're like 17, 18 times. They're a little bit expensive, but we're growing tremendously, which supports that valuation for now. Like I said earlier, and you mentioned as well on Tematica website, how earnings are going to decline not decline, but slow significantly year over year if you're looking at first quarter next year. So, what do you, not that what you advise clients, but I guess how would investors position themselves? Should they be a little cautious here, or are you really cautious, like seeing a much more bigger pullback maybe over the next, and no one knows what's going to happen next quarter, the quarter after, but say like over the next 12 months? Or is it, you just got to be careful, pick your spots, and maybe certain sectors are going to do better than others that maybe won't be as impacted. Just like we're seeing small caps, right, really outperform the markets because they don't really have tariff concerns because they don't do a lot of business overseas, at least most of them. So how are you positioning yourself in this market?
Yeah, I'm with you. I think the small cap is just going to be safer because this trade war, to all this talk, I don't think it's going to end anytime soon. So that is definitely a headwind to those bigger S&P companies that derive, the S&P derives more than 50% of its revenue from international. So that's going to be a little bit of a headwind. Plus, with the dollar strengthening, that's also a headwind to those companies that generate their revenue overseas. That being said, because there's two things, there's the economy and then there's the stock market. So with the economy, I am concerned that we're going to be slowing. There are some very big issues with the level of debt in a rising, the debt levels being at record levels. Now we've got a rising rate environment. You put those two together and you have the demographics of an aging population. I mean, there's a lot of things here that have me very, very concerned for the economy, more the 12 plus months out. The stock market, which is separate, they're related. You usually don't get a complete bear market unless you're in a recession. But the stock market and the economy can operate very independently. As far as the stock market goes, I think there's still quite a bit of legs in this because we're still seeing companies buying an awful lot of their shares back. The thing I'm watching is when I see those share buybacks really slowing, because that's really what's driving share price these days. It is not individual investors. There's not a whole lot of that going in there. It's all about share buybacks. When I see that companies are no longer able to do that, that's when it's going to get ugly.
No, it definitely makes sense. And we've been going crazy on the macro, but I want to give you a chance to talk about your podcast, right? Which is called Cocktail Investing. And yes. You have a partner, but to be honest, we both know that you're the big star on that podcast. I had to take a shot. Her partner is Chris Massaje, who's actually I interviewed him about 9 months ago and is a good friend. And I work with him at TheStreet.com. And actually saw him in the New York Stock Exchange not too long ago when I was ringing the bell with US Global. So, but talk a little about your podcast, because I always like to see people get into this. I've been doing this for 10 years, and it's a lot of fun. It's not like competition, because you can listen to a podcast anytime. It's not like they all come out at the same time, but
Exactly.
it's really cool. And I can tell by you guys just listened to a few that it becomes addicting as well. I just want to get your thoughts on it and tell everyone about your podcast.
Oh, thanks. Yeah, we so the podcast is called Cocktail Investing, and it's all about our focus is distilling everyday noise into investable signals. So what our whole focus is to try and take all the complex stuff that you hear out there and all the headlines and break it down to what really matters, and to make it easy to digest, because an awful lot, one of the things that's always kind of drove me nuts about Wall Street is just the love of jargon that makes it sound, really complicated and really hard to understand when it doesn't really need to be. So for us, it's a lot of fun to just break it down into stuff that's more easily relatable.
No, that's cool. And when do you actually is it a weekly podcast, or how often is
Yes.
it when people listen to it? Yeah.
Yeah, we have it. It comes out every week. Typically, we come out on a Thursday every now and then, because I tend to travel a ton for work. I have a base in San Diego, one in Geneva, Italy, and another in Dublin, Ireland. So depending on what time zone I'm in, sometimes it gets pushed, but mostly it comes out on Thursday.
So how does that work? So where exactly do you live? Because you're doing this interview from where? I think you said you might be in Italy or Ireland, but I'm not too sure where we're doing this interview from.
Yeah, today I'm in, if you can actually believe it, I am in hot and sunny Dublin, Ireland. It is unreal right now how hot it is here. They're having like I think it's the warmest summer in something like 40 years.
But it could actually,
yes,
I mean, it could start raining like in 10 minutes though, right? And be cold.
It should. We desperately need it. It's everybody's starting to have to water their lawns, which just kind of has everyone scratching their heads, because that's not something you do in Ireland. But I'm here, and then I'm also in Geneva, Italy, which is just south of Milan, right on the Mediterranean.
Wow, that's a pretty cool life.
It's not
I
bad.
want your job, actually. I want your job. That's a cool job. Well, next week I'm going to be in Italy, and next week I'll be in Ireland, and that's cool. Good for you. Awesome. Now, I want to get just a few more questions in here before we end, because we talk a lot about the macro, right? Which is, interest rates, went over GDP, went over tariffs and stuff like that. Things that can impact your portfolio. But as you know, as well as I know, when it comes to individual investors, they want to know about this stuff, but also they want to know maybe about different trends that people are looking at. And I want to go into that part, which also covers macro. What are some of the trends that you like right now that you're looking at for Tematica, and maybe one or two of them, because I've seen that you do cover some technology trends, and I'm curious to know which ones have you very excited right now.
One of the things that has us really excited is we call it the connected society. And that is, you think over the past like 20 years, we've gone from where having a desktop was really exciting, but you're trapped in an office, or maybe you're lucky enough to have one at home. Then we got to laptops, started getting a little more interesting. But now you think about what you have with a smartphone, and you have more computing power in the palm of your hand than we had to put the Apollo spacecraft up. And that tiny little thing in the palm of your hand also has access to almost all of the information known to mankind, and allows us to connect and interact with each other in ways that were unimaginable years ago. So that's a big macro trend, right? And that's enabling all kinds of incredible things, where people in third world countries are able to become banked, and they're able to start engaging in the modern world where they couldn't before. And now you can have, some guy in a very remote location can actually have a way of transacting with people. So with that, one of the things we always like to look at is how to buy the bullet and not the gun. So if you're looking at these smart devices, all this technology that allows us all to connect with each other, what trends are happening there? And one of the things that we see is these screens so this is like drilling all the way down from the big picture. One of the things that we see is the evolution of screen technology, because when we don't like to have to pick, exactly like this company is going to be the one that's going to deliver the ultimate device. What we like to go with is more the evolutions of technology.
No, that's interesting. Is it more like, instead of buying Apple, maybe you buy Apple suppliers or nuts and bolts companies and things like that? Or, because, go ahead.
Yeah, exactly. Like chip manufacturers. Like one of the things is rather than trying to figure out, is it AT&T or Verizon? It's, hey, what's happening with 5G? Well, they're all moving to 5G. Okay, what do you need for 5G? What kind of chips do you need? What kind of infrastructure do you need for 5G? So that way I don't have to pick if it's going to be Verizon or AT&T that's going to win the 5G race.
Yeah, it definitely makes sense. I appreciate you sharing that with us too, because I know you guys do look at sectors and has you excited, and thank you for sharing that. Now, Lenore, my listeners, if they want to learn more about you and actually be able to read some of the stuff that I keep saying that I read, how can they actually do that?
You guys can go to tematicaresearch.com. That's TEMATICA, tematicaresearch.com. And you can find me there under market commentary. There's L's Economy, where I write pretty regularly about what I'm seeing going on in the world.
And that's great. And they can also follow you on Twitter. I know you have a Twitter handle, which is?
Yeah, L's Economy.
See, look at that.
And also on Facebook.
I'm actually plugging you. How great is that? It's awesome.
That is great. I appreciate it. I'm terrible at doing that. So
I'm terrible. I know. But you interview some people not going for 20 minutes and stuff, and I'm like, all right, enough of the plugs. But no, I appreciate that, because I'm exactly like that too. I'm just like, if you want to find me, just go to my website or whatever. But I really appreciate you taking the time. I know you do a lot of interviews on Fox Business and a lot of interviews everywhere. I know how busy you are, and the fact that you're doing this from overseas. I just want to say I really appreciate it. I know my listeners are going to love this interview, and hopefully you'll come back again soon.
I would love to. Thanks so much. It was my pleasure.
Okay, guys, great stuff from Lenore. Man, I'm jealous. She's in Ireland right now. It's going to be in Italy pretty soon, then in California. It's kind of a great idea, right? We have 3 separate families that you see a few weeks at a time. But spouses would get along so much better that way. I'm just kidding. I'm kidding. Always going to bust my you-know-what for that comment. But all kidding aside, I thought Lenore did a fantastic job. Newest stuff, no hype, great analysis. But this podcast is about you, not about me. So let me know what you thought at frank@curzioresearch.com. That's frank@curzioresearch.com. Now, let's get to my educational segment. So the Professional and Amateur Sports Protection Act, known as PASPA, was established in 1992. It's a federal law that prohibits gambling on individual sports games in America, with the exception of, and the monopoly they created, Nevada. Now, last month, specifically May 14th, the U.S. Supreme Court ruled that this Protection Act is unconstitutional. This decision, basically a long time coming, where most gaming companies believed this law would be overturned years ago. And it was really expected because New Jersey challenged this through the appeal process. So people were expecting this to happen. It happened by a pretty wide margin. So following this landmark decision, each state can now legalize gambling, including sports betting, which is the big deal here, which I'll explain in a minute. And you know what? They're not waiting long to make this a reality. So a few weeks ago, Jersey, Delaware signed bills to allow sports wagering in several of its casinos and racetracks. You have Mississippi, New York, Pennsylvania, Rhode Island, West Virginia enact state laws to allow sports wagering in select casinos and racetracks in their states. This is going to happen over the next few months. So we have around 14 states are expected to legalize sports wagering over the next 24 months. Some in 3 or 4 months, some 6 months, some a year, but over the next 24 months. But close to 70% of the states are expected to legalize sports wagering inside of 5 years. Now, what does this mean? Because you're looking at this decision and saying, well, why is it a big deal? Who's going to benefit? I've seen it all over TV. And it's interesting because when I look at the fantasy sports players, DraftKings, and the amount of money put into those companies, given the fact that there's so much legal stuff. I mean, there's massive amount of private equity that flew into those companies. But you know what? They were smart. Because if you look at the lobby dollars, especially from the gaming companies, the amount of money spent by these people to get a handle of what decision, what's coming up, what's going to happen is unbelievable, especially if you look at the spending this year compared to, or even in 2017 compared to previous years. They want to get ahead, and they want to get ahead of this big ruling. Now, let's throw some numbers behind this. Because according to the Nevada Gaming Commission, $138 million was wagered on this year's Super Bowl. Yes, the one I went to, the Philadelphia Eagles won. The Eagles won the Super Bowl. I keep saying that because it's the first time they ever won it. After this year, I'm a little nervous, even though they look good going into next year. Anyway, the Eagles, who never won the Super Bowl, get that out of the way. $138 million wagered. Again, Nevada Gaming Commission. That's where this number came from. The thing is, this number is a complete lie. Because Nevada is the only state where you can legally bet on the outcome of individual sports games. This includes big events like college basketball's March Madness, if it's the NBA championship games, and of course, the Super Bowl. But outside Nevada lies the biggest black market in the world. So everyone else in America goes to bet on their favorite sports teams, whether it's your local bookies, different places, whatever. You guys do what you want. Everybody knows it exists. Not a secret. You know it exists. I know it exists. The government knows it exists. Everyone knows it exists. Now, according to the American Gaming Commission, it wasn't $138 million that was wagered on the Super Bowl. It was more like $4.7 billion. That's over 3,000% more than a number being reported by the Nevada Gaming Commission. In fact, according to a report filed by the National Gaming Impact Study Commission, you could tell I've been doing a ton of research on this. Nearly $400 billion is illegally wagered on sports every year. And this is a study from 1999, so this number is super conservative. It could be when accounting for inflation, but we've seen numbers being reported by Bloomberg between $150 billion to $300 billion. So here's a company that says around $400 billion. Now, again, I think this number is super conservative. You know why? Because think of all the people that want to bet that can't. I mean, I would have bet the Super Bowl if I had access to some, an online site. I would have put up, whatever, $100 on maybe a little more on the Eagles, but I really couldn't bet it unless you're physically going to a casino in Nevada. So when you're looking at this number, it's incredible. Now, you don't say this market's a $400 billion market. It's not. But if you assume the average hold, what does that mean? It's basically the percentage of money made by the bookmakers, which is about 5 to 10%. If we take that $400 billion number, it's basically a $20 billion to $40 billion market that's up for grabs and created by the Supreme Court ruling last month. So it's in its infancy. Some of the stocks have risen 10, 15%, but they pull back with the market. So you still have a chance to get into this trend early. But the key is, and from my research, this market is growing like gangbusters. I mean, it's incredible. If you look at the Nevada Gaming Control Board, they had a record $4.8 billion that was legally, right, this is Nevada, wagered on sports in Nevada last year. It was the 8th straight year where bettors in Nevada wagered more money on sports than the previous year. So it keeps hitting a new record year after year after year. Again, this number only includes money wagered by people going into the casino in Nevada and placing bets. In other words, these bets are not being placed on mobile phones over the internet. And maybe there's a few sites that you could, but you have to be, sure that you live in Nevada and stuff like that, I believe. But hardly any bets in America are placed on mobile phones and the internet. But going forward, every state is going to be allowed, if they want, to allow sports betting through mobile phones, internet. And this is the biggest opportunity in this space. So if we're looking for a better comparison, we're not just Nevada, which is a small market. You will look at the UK, because betting in the UK is fully legal, including in person and remotely, which is mobile phones and online. And according to the UK Commission, roughly $18 billion was wagered on sports games, just sports games. So it includes horse racing and dogs. Okay, that's annually. Now, the amount of money generated by the gaming companies, which is called gross gambling yield, I don't want to get too technical and lose you here, because it's a big story here, was about $2.1 billion. So if we take that number, the average hold, which I mentioned could be 5 to 10%, in the UK, the average hold is around 11%. Can we apply this 11% to the $400 billion market? It's $44 billion. Let's say it's half the market of $200 billion. It's still $22 billion. That's an incredible market that was just created out of thin air from a signature, from a couple people saying, yes, no, yes, 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 no. It's incredible. But when you look deep into the numbers in the UK, there's a massive secular trend taking place within the gaming industry, and that's online betting. It's now the largest component of gambling in the country. So betting online has basically increased over 30%, and we're looking at a compound annual growth rate since 2010. So if you want to put that in perspective, remember, guys, 2010 we're taking. 2010. What does that mean? What do you think 2010, just after the credit crisis, right? The market's near their lows. If we compare that to the gains of the S&P 500, it's nearly 3 times faster than the growth you would have if you put your money in the stock market in 2010, which is pretty close to the lows. So that's an incredible number just to put in comparison. So using the UK as a test case, I mean, the potential growth of sports wagering in America is absolutely enormous. It's incredible. But a lot of people out there that I see, they're recommending stocks, they're recommending the wrong stocks. Like if you're looking at the 3 big ones, the ones that I cover, right? I went to Macau to do some extra research. I've been to Macau, which is cool. When Las Vegas Sands, what do? They're like, we're in Vegas and we're going to go to Macau and build massive casinos and maybe a couple here, Singapore, whatever, and go international. And you also had MGM Resorts kind of in that, more of a Las Vegas play, where Wynn and Las Vegas are more Macau plays with operations in Las Vegas. These aren't the winners here. These companies have little to gain from this loss since they don't have casinos in individual states. Not that this is going to really hurt them too much. It's not like people they're going to lose the gaming revenue in Nevada, but there will be people that aren't going to travel in Nevada maybe so much if they could really bet online. It's happened with every single industry. Tons. You name it. They want to go there. But you will see a lot of people just wake up and throw money on a bet through the internet or mobile phones, which again is a massive market opportunity. So it's not just sports betting, it's being able to bet on mobile phones, being able to bet through the internet. So you want to look at the companies that are going to create online platforms. In the US, it gets complicated because you can have a state approve it. Well, you probably have to live in that state. There's going to be a lot of gray areas. So what you want to do is look for companies that already exist, that have these online platforms, and there's not many. But that's going to be the biggest beneficiaries here. Also, some big winners would be Penn National Gaming, Boyd Gaming, Churchill Downs, I think is going to be a big winner. These guys have racinos, or basically casinos inside a racetrack, but now they could really expand. Now you're going to have sports betting. Sports betting is a monster industry. It's a conservative number. And these are estimates, but think about it. Think about all your friends, the Super Bowl parties you go to. And how many people are going to bet the game if they could simply go on their phone? Whatever, if it's $5, $10, $100, fantasy sports, whatever it is. It's going to go through the roof. You can look at gaming suppliers like International Gaming Technology, Scientific Games. You guys can figure out the symbols. I don't have to give you all of them. Penn National Game is PENN. Boyd Gaming is BYD. Churchill Downs is CHDN. International Gaming Technology is IGT. Scientific Games is, I believe it's SGMS. I'll be nice. Do a little work for you. That's the type of guy I am. But when you're looking at the clear leaders, and those guys are going to be beneficiaries, I think they're great buys. They went up after this ruling 10, 15%, and probably pulled back half that amount, the market coming down. It's a good buying opportunity. Again, it's not going to happen quick, but it's a massive market open to the fastest people who could make this happen, whether it's the states, whether it's the companies. But you want to go after the people who have existing online platforms, because that's where the massive amount of growth is going to take place. And there's one clear leader that's probably going to become the Amazon.com of the gaming industry due to this new ruling. The manager did a great job positioning itself over the past 6 months, become the leader in the online space. Again, there's several of them. You can look at them. But the one that I found, very difficult to find on screens. I won't tell you why, because you'll probably find the stock, but I just recommended this company to Curzio Venture Opportunity subscribers. A little bit higher market cap than what I used to recommend. Not so much a small cap, a little bit bigger than a small cap. But it's amazing how this company positioned itself, doing things that were completely under the radar, that when I was researching this company, I was like, whoa, they obviously knew this was going to happen. I mean, it's not the biggest surprise ever if you really follow the industry. But to make the acquisitions, to really spend money, to increase your presence online, to become like this massive behemoth. And there's a lot of risk to doing that, considering, you're going to be dependent, and you're spending billions to do this, dependent on, a few judges making a decision you hope is going to be right. This stock's going to benefit. I mean, profit, sales, free cash flow are going to surge. So the gaming industry moves more online. But guys, that's what you want to search for. Okay, I just gave you a whole bunch of names. Don't buy the MGM Resorts, Wynn Resorts, Las Vegas Sands on this catalyst. Doesn't mean they're not buys. They're just not going to be the big beneficiaries over here of this. Yeah, we see plenty of revenues. Those are giants in the space. They get hurt a little bit, but not too bad. But some more localized players that have these little casinos in Mississippi or whatever that now can have sports books everywhere. And the fact that you can go online and register, and if you're looking at some of these companies, it used to be crazy back then, but if you're looking at online, it's a regulated industry. The regulators don't mess around in all the states. I think it's like 17 to 20 jurisdictions that approve this. And in order to improve it, what did you have to do? Because I don't know if you guys played poker in the past or played different things. If you ever wanted your money, it was like forget it. It was like impossible. It was impossible. And if you ever asked if you're doing well, you say, okay, send me, whatever it is, whatever amount of money. It was, okay, we got to do this. We can't bring it to your bank. We can't do that. Blah, blah. And next thing you know, you get a check from like Joe's Crab Bistro or something because there's just so many loopholes they had to go through. Now it's directly linked to your account. You press a button, it transfers to your account. You have hundreds. I mean, they're required to have hundreds of people monitoring this, making sure everything's perfectly fine, perfectly safe, believable, especially what happened in the past with a lot of these industries where people went to jail because it was screwing people. It's a much safer industry. Why? Because if you do it right, and I hope people in China are listening, like if you don't lie and fudge your numbers or anything, you're eventually going to be the greatest economy in the world. It's going to take longer to get there if you keep doing what you're doing. But they realized, hey, you know what? If we just take a little bit of the rake on each hand that we deal in Texas Hold'em, Omaha, or roulette and the spin of the wheel, we're going to make an absolute fortune on this if we do things the right way. So they did. They've been doing things the right way over the past couple of years, and that's why this industry has got more credible. But it's a big opportunity. Start doing your research. Still time to buy a lot of these names. It's very early in this trend. A lot's going to happen. You're going to see maybe a few setbacks back and forth. The rules aren't too clear right now, but states right now are running to get this approved. So 14 is going to happen pretty quickly. We have 35 in total. They all have some kind of bill legislation ready to be passed. The boom, some of these states are going to generate a lot of revenue of money that is already being bet. So it just makes sense to collect some money off of this in tax revenue, which every state needs. That's why they could spend 10 times more money than what they bring in and are never held accountable. But it's just a win-win-win for everyone. Forget about your political beliefs. If you don't like gambling, if you have people that are just had trouble gambling, I get it. I understand. I'm just saying from a stock perspective, which is my job to bring you great industries, great stocks to buy so you can make money off of it. This is an industry. It's still very early where investors can make a lot of money if you invest in the right stocks. Okay, guys. Hopefully you love that sector. Hopefully you love Lenore. It was a great interview. Again, I want to hear from you. Frank at CurzioResearch.com. That's Frank at CurzioResearch.com. And that's it for me. Thanks so much for listening. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.